We have CBS News business analyst Jill Schlesinger here in Studio 57 with us to talk about what this means for the economy, what sort of snapshot it's giving us. So I'll start with sort of the overall umbrella question, which is, what do you make of today's report?
Solid, as expected. Most of the consensus fell around 250,000 jobs. That means if you thought anywhere between 200 and 300,000 jobs is pretty much on the nose.
Okay.
Thank goodness economists have been taking it on the chin, missing these estimates all over the place.
Yeah.
So I think that's, just shows you that the job market is shifting. Because go back to last year, and we had monthly job creation averaging more than 500,000 a month. Mm-hmm. Even in 2022, we've got 420,000 jobs a month. Now you look at this report, 263. So that tells us that the job creation is starting to slow down. And that is expected because, first of all, you're not going to have 500,000 jobs a month forever. Mm-hmm. We have now recouped all of the jobs lost amid the pandemic, 22 million. We're about 500,000 over that.
Okay.
And also, we should point out that the unemployment rate did dip to match that 50-year low of 3.5%. Don't get too excited about this, because part of the reason the unemployment rate remains so low is we don't have a lot of people in the labor force. The participation rate among adults, people in the labor market who have jobs or actively seeking jobs, kind of at a low level, and we have not been able to claw back from that since the pandemic.
That is interesting. And so I wonder what this means for inflation. I don't know if it's a good or a bad thing, because if more people are working, then that means more people are spending money. That means companies aren't really motivated to drop the prices on anything.
You have just created the conundrum of the Federal Reserve in one simple question. So that is what they are trying to balance. Think about this. You're the Federal Reserve. Inflation remains too high, over 8%. And even the core rate of inflation is way high, over 6%. Mm-hmm. Wages are up by just 5% from a year ago. That means a lot of Americans are falling short. Yeah. They are using their savings they built up during the pandemic to help them out. But now there's going to be some point where there's no more savings. Mm-hmm. And that's going to put a ton of pressure on individuals. And you're right. If we don't have enough people spending money in the economy, then this is a self-fulfilling prophecy. Now, here's the critical question for the Fed. How much is too much?
Yeah.
Problem? We don't know until after the fact. Raising interest rates is a blunt instrument. This is the problem. So we see that the Fed's raised 5 times already this year. It's an aggressive rate hike. Mm-hmm. They're probably going to go again in November and December, maybe by another 0.75 percentage point, maybe a half. But what is really clear is that the inflation rate is not coming back fast enough for the Fed. They may only know next year, after the fact, that they went too far.
Is there not, this is a little bit of a departure, but is there not some sort of equation to predict what could happen? I understand, you raise interest rates and it's, it takes a while before we know what's going to happen, expected. But, they can't just be sort of throwing darts at the wall.
Okay, all right. They are economists, and my friends who are mathematicians will often say to me, economics is a soft science. It's not a hard science. Okay. And what do they mean? There's no magic formula. Yeah. So they're looking at a lot of different data points, and they're trying to determine where it is that they need to be. But, there isn't a way to algorithmically predict what is going to happen in the economy. So think of it almost like a meteorologist, right? I'm a great meteorologist. I studied all these years. Right. I have models. I know how storms move. But there are so many variables when it comes to a storm that we don't know whether the path of Ian is going to go left, right, south, north. We kind of get a general idea. So the Fed knows generally we're slowing things down. We hope prices come down. They're looking at the housing market maybe as the sharp tip and seeing that housing activity is down. And now we know that mortgage rates are really high, and that is actually diminishing the prices in some markets, not all. Yeah. And they're hopeful that that's kind of the way the economy overall starts to act, that they dampen demand for borrowing, people spend less, and that actually helps the economy slow down, especially at a time where we know that the supply chain is not perfect, but it's a lot better than it was.
Yeah, that's such a great comparison, a meteorologist. So back to this jobs report, right? We talked about what it may look like in terms of the economy. How is the stock market reacting? The stock futures fell slightly this morning.
Yeah, I think this is going to be a nothing burger for investors. The market could go all over the place, and I have no idea what happens day to day, month to month, frankly. Here's the good news. You don't have to worry about that either because you are all long-term investors. And for us, in the just sort of general, boring kind of investors who look at retirement and college funding and all those issues in the future, we don't have to worry what happens day to day, week to week, month to month, even year to year. So I want everyone to sort of remember this as you go into the weekend. If you feel like you want to go check your 401k account or your IRA, just do it with a healthy dose of skepticism, right? That like, okay, this is where I am today. I don't have to do anything about it.
Right. And even if you're on the verge of retiring, you're not taking all the money out at the same time. You're just taking what you need. So don't worry. You're
and
still
your
in
money's
for the
going to
long haul.
last you decades in the future.
Right. Okay. Last question. Next week, the Bureau of Labor Statistics will be releasing the Consumer Price Index report. Right. That's going to give us a snapshot of where we are when it comes to inflation. What's the expectation?
Well, I think the top line rate of inflation will come down a little bit. So maybe we go from 8.3 to 8.1. We'll see. The problem is the core rate that pulls out food and energy is going to show that we are still very much in an inflationary period. We might even see an acceleration of the core rate from, maybe 6.23 up to 6.5. And that's going to freak out the Federal Reserve. They don't like that. But remember, shelter, which is such a huge part of all of our families' budgets, is still rising in many markets. We're seeing some evidence that rents are starting to come down. Yeah. But if you think about food, rent, and energy, those are your big three. And we haven't seen anything except we see gas pump prices come down, heading back up a little bit.
Yeah.
But those two other areas, food and shelter, occupy a big portion of your budget, and I think we're going to see potential acceleration in those two areas. So it's not going to be a great report next week.
No, not at all. Jill, thank you very much.
Great
Still
to be
happy
with
to
you.
see you.
Thank you.